Welcome to this week's edition of Macro and Flows from Orestes Capital. For the week ending on August 7, 2026, we're Elena and Marcus.
Right. And today we are looking at the mechanics behind a market that is quite literally walking on a tightrope right now.
Yeah, we have a situation where algorithms are buying blindly, retail investors are aggressively trading earnings, and over $16 billion in options just vanished into thin air on Friday.
It is a precarious setup. The prevailing narrative across the street is incredibly loud right now, very bullish. But our internal modeling is signaling something completely different.
Exactly. Our mission today is to cut through that noise. We are going to examine the proprietary OCM PCA model to understand the actual regime driving asset prices, analyze who is buying and selling, and look at the upcoming macro calendar.
And we also need to demystify the options market plumbing that is currently pinning the S&P 500.
Right, which will lead us to lay out the most likely pain trade for the week ahead. So let's start with our primary compass, which is the OCM PCA model.
So PCA stands for Principal Component Analysis. To explain this simply to you, the listener, think of this model like a submarine's sonar system.
Because if you navigate just by looking at the surface of the ocean, you are just going to get seasick.
Precisely. On the surface, you have chaotic daily waves. Those are your daily stock fluctuations, the earnings headlines, the media panic. It's just noise.
And the PCA model filters that out.
It completely filters out that surface chop. It looks deeper to track the massive, slow-moving ocean currents underneath, because ultimately those underlying structural currents are what dictate asset prices over the medium to long term.
And right now, that sonar is tracking a very specific, powerful current. Our proprietary modeling places the market in a deeply entrenched euphoria or reflation state.
Yeah, it's a late-stage macro euphoria. When we break down the output, global growth, which we categorize as principal component 1, has accelerated sharply over the trailing 3 weeks.
It is currently sitting at the 90.7th percentile.
Right, but here is the critical part. The rates and reflation component, which is PC2, is peaking and beginning to cool.
The primary drivers pulling that reflationary component higher have been rising German 10-year and U.S. 10-year yields, along with strong copper prices.
But you have to understand the physics of what happens when rates and reflation begin to cool while global growth remains stretched up at that 90.7th percentile. It signals a major inflection point.
The market is essentially pricing in absolute peak economic momentum.
Exactly. If growth falters even a fraction of a percent from here, that reflationary trade unwinds rapidly.
Let me push back on that for a second, though. With all the massive earnings beats we just saw from the technology sector, couldn't this growth spike just be a post-earnings sugar rush? Are we misinterpreting a transient anomaly as a structural regime?
Well, it's a fair question, but the mathematics of the PCA model rule out a transient anomaly. When you analyze the 3-year and 5-year rolling windows within the framework, they completely agree with the short-term data.
So the long-term data backs it up.
Entirely. This euphoria state is robust across multiple time horizons. Our internal factor signal confirms this is a deeply rooted structural state, not just a temporary blip.
Which creates a really stark contrast with the consensus across the street. Market intelligence shows $33 billion in equity fund inflows recently.
Right. The prevailing narrative assumes this is just a standard bullish continuation, a simple overweight tech rally.
But our modeling confirms this is a late-stage macro euphoria environment. So since the model confirms this late-stage regime, the next logical step is to see who is actually moving the money, who is aggressively allocating capital at these stretched levels.
Let's look at the systematic trend followers first, specifically the CTAs. For you listening, CTAs are commodity trading advisors, but in today's market, they are basically computer-driven algorithms designed to identify and ride momentum.
They operate like a car with adaptive cruise control set to 90 miles an hour.
Exactly. They automatically accelerate and buy when the market goes up, and they mechanically hit the brakes and sell when the market drops. Their execution is completely devoid of emotion or, fundamental analysis.
And right now, they are not looking at the road ahead at all. Market intelligence shows CTA equity allocations are currently in the upper half of their historical range, sitting at the 78th percentile.
They are heavily long in European and U.S. equities. And across other asset classes, they are aggressively shorting gold while holding massive long positions in copper and oil.
If the road suddenly ends, they don't hit the brakes until they are already in freefall.
Exactly. Now, contrast that blind algorithmic buying with what you are seeing from retail discretionary flows. Retail investors are exhibiting highly specific active behavior right now.
We see this vividly in the data. Market intelligence indicates retail is actively taking profits and aggressively selling single-stock hyperscalers, specifically software companies, immediately following their earnings spikes.
But they aren't moving that capital into cash. They are immediately rotating it to buy the dip in semiconductor stocks and broad technology ETFs.
Which is a critical divergence.
Yeah.
You have CTAs blindly riding the momentum, carrying heavy long positions simply because the trend is up, while retail is actively managing and selectively trimming their specific tech exposures.
And this creates a very dangerous underlying market structure. Think about the mechanics here. You have algorithms operating near peak historical allocations, fully loaded on risk.
Simultaneously, the retail base is selectively trimming their exposure to the market leaders.
Right. So if a macroeconomic shock hits and breaks the upward trend, the CTAs will mechanically execute sell orders. But if retail is already fully allocated or taking profits, who stepped in to absorb that selling pressure?
The marginal buyer is completely absent, and that vacuum creates severe downward pressure.
Which brings us to the obvious question. What could potentially trigger that shock and force these mechanical players to sell?
To figure that out, we have to look at the upcoming economic gauntlet and the structural credit risks building beneath the surface. Next week's macro calendar is formidable.
It really is. You have the market digesting the July CPI data on Wednesday, which is expected to show inflation at 2.5% year over year.
That is immediately followed by the PPI on Thursday and retail sales data on Friday. Any upside surprise in those inflation metrics could easily act as the catalyst that breaks the trend.
But while everyone is focused on the macroeconomic data points, there is a physical, structural drain on market liquidity happening at the exact same time.
The Treasury auctions.
Yes. Next week, the U.S. Treasury is scheduled to sell $58 billion in 3-year notes, $42 billion in 10-year notes, and $25 billion in 30-year bonds.
Let's break down the physics of that for a moment. When the government issues that debt, it acts like a giant sponge. It physically soaks up cash from the financial system. Institutional investors, banks, and funds take their cash and hand it to the Treasury in exchange for those bonds.
You are looking at $125 billion in sovereign supply hitting the market in a 72-hour window. Every day, liquidity in the financial system is finite. When the government absorbs $125 billion of capital, that is $125 billion that is inherently unavailable to support equity valuations.
Or to act as a buffer during a market shock. And this vacuum turns on at the exact moment the market is trying to navigate critical inflation data.
Adding to this pressure are the hidden credit risks that our market intelligence is flagging. Specifically, we need to look at the underlying health of CRE/CLO deals.
That stands for Commercial Real Estate Collateralized Loan Obligations.
Right. The underwriting assumptions in this space are becoming increasingly aggressive. Market intelligence shows that 15 out of 24 recent deals exceed the long-term average risk score.
And the composition of that risk is the real issue. There is a heavy, dramatic shift toward high-risk renovation loans rather than safer burn-off concession loans.
To understand why this is critical, you have to contrast the two. A traditional, safer commercial real estate loan is a burn-off concession loan. In that scenario, the property is already stable, the building is occupied, and the owner is simply waiting for a temporary rent discount to expire to increase their cash flow.
The foundational risk is low.
Exactly. But a renovation loan is an entirely different beast. These are loans where the underlying property requires significant capital expenditure. They need actual physical construction and successful future leasing in a high interest rate environment just to achieve the projected value that the loan is based on.
The execution risk is massive. The surface looks pristine, but the plumbing underneath, from the Treasury supply absorbing liquidity to these commercial real estate loans masking fundamental risk, is under increasing pressure.
It begs the question of why the market hasn't cracked yet. What is physically holding it up?
Well, speaking of plumbing, the most immediate structural force holding the equity market together right now isn't macro data at all. It's the options market.
This is where the structural mechanics get fascinating. On Friday, the S&P 500 closed at 7,757.64. But throughout the entire session, the market was pinned by a massive auctions magnet precisely at the 7,750 level.
It was essentially glued to that specific price. To understand how a market gets pinned, we need to demystify the concept of dealer gamma for you.
Think of Wall Street options dealers as the market's shock absorbers, or a thermostat. They are the middlemen. When you buy a call option, betting the market will go up, the dealer on the other side of that trade takes on the opposite risk.
And to protect themselves, they have to hedge. They buy and sell the underlying stocks to remain perfectly neutral.
Right now, these options dealers are in a long gamma state. When dealers are long gamma, the mathematics of their hedges force them to sell stocks when the market rallies and buy stocks when the market dips.
They are constantly trading against the market's momentum. This mechanical buying and selling acts as a massive shock absorber. It suppresses volatility and locks the market into a very tight trading range.
It creates an artificial calm. The market looks completely stable on the surface, but it is entirely engineered by these hedging mechanics. But there is a massive hidden catch to this stability.
The expiration risk.
Yes. That 7,750 pin, which acted as the anchor for the entire market on Friday, was supported by $16.7 billion in 0 days to expiration options. These are the zero DTE options, and by definition, they expired at the close on Friday.
So what happens on Monday morning when that $16.7 billion anchor is entirely removed?
The mechanics invert. Once those options vanish, the dealer's shock absorbers are effectively removed from the market. The dealers no longer have the gamma exposure that forces them to buy the dips and sell the rips.
So the market is unpinned.
Completely. It becomes free to move violently in either direction, completely dependent on the organic morning flows. The volatility suppression that everyone relied on Friday simply vanishes overnight.
With the options anchor lifted, everyday liquidity tightening due to the Treasury issuance, and our OCM PCA regime showing stretched growth, we have to look at the pain trade.
The pain trade is the scenario that causes the maximum amount of financial distress for the majority of market participants who are currently positioned incorrectly.
And our proprietary modeling is flagging structural exhaustion that the mainstream media is completely ignoring. When we look at the long-term components, the 3-year global growth slope is mathematically categorized as stretched positive.
Simultaneously, the 5-year rate slope is stretched negative. When these components stretch this far from their historical baselines, the model warns of an impending, violent mean reversion.
We are pushing the absolute mathematical boundaries of the current growth cycle. And the specific risk in this late-stage euphoria environment is a sudden, sharp volatility expansion.
Historical base rates for this exact market state project significant increases. Historically, in this regime, the VIX expands by 1.50 points. Even more concerning for the bond market, the MEE index, which measures fixed income volatility, jumps by 2.05 points.
And this volatility threat intersects dangerously with recent institutional behavior. Consensus Intelligence notes that massive multi-strategy and technology-focused hedge funds have suffered severe losses recently.
For you, the individual investor, here is why that matters. When these funds lose capital, their prime brokers force them to mechanically shrink their risk budgets.
The prime brokers are tapping these funds on the shoulder and forcing them to liquidate, whether they want to or not. When a multi-strategy fund breaches its volatility limits, the selling is compulsory. It does not matter if they believe in the fundamental value of the technology stocks they hold, they have to sell.
If these hedge funds are forced to step away from the market to reduce risk, the current technology trade becomes dangerously reliant on retail investors and leveraged ETFs.
It removes a major institutional safety net.
Exactly. Given these compounding structural risks, the OCM model outlines specific, actionable portfolio adjustments based strictly on the 4-week forward state conditional returns. Let's walk through them.
I'll start with equities. You must de-risk broad equities. The euphoria state has historically been a poor entry point for broad market beta. You need to reduce exposure to cyclical equities.
Regarding commodities, the model suggests an overweight position in energy. Brent crude offers a highly asymmetrical setup right now. The model projects a 2.48% forward return in this specific macro state. There are also positive setups for copper and gold.
For fixed income, it is imperative to hedge fixed income volatility. As we discussed, the MEE index projects an upward jump. Portfolios should reduce naked duration risk and utilize swaptions to protect against abrupt rate sell-offs.
Finally, in credit, you must rotate up in quality. In this specific late-stage euphoria environment, high-yield credit spreads have historically moved wider by 2.29 basis points.
To translate that simply for you, credit spreads widening means that the extra yield you demand for taking on the risk of corporate debt over safe government debt is going to increase. When that required yield goes up, the actual price of those high-yield, high-risk corporate bonds drops. You absolutely do not want to be holding low-quality paper when that repricing occurs.
That covers the positioning. I want to leave you with one final dynamic to consider as we enter next week. If algorithmic CTAs have their cruise control set to blindly buy, If hedge fund risk budgets are being mechanically forced down by prime brokers, and if the dealer shock absorbers just vanished into thin air on Friday. What happens to this market if Wednesday's CPI data forces retail investors, the last remaining pillar of support, to suddenly hit the sell button?
See you next week, wherever the flows take us.